Homes for sale are up 36% year over year in March. New listings are up almost 16%. Homes are sitting on the market longer and price cuts are becoming the norm. The Texas Real Estate Research Center reports the recent jump in inventory levels are signs of lagging demand struggling to keep pace. The article continues, February is the 13th consecutive month where inventory is expanding at a rapid pace of 30% year over year, outpacing demand. Inventory has risen to approximately 35% above pre-pandemic levels, shifting the market conditions in favor of buyers. Initially, after the pandemic boom, I was like, inventory better rise. It was at all-time historic lows, and we saw what that did to home prices. So seeing inventory rise is a good thing, but what we're seeing right now is that there's so much of it that it's affecting prices. The report continues, while inventory growth benefits buyers and gives them more leverage and time to make decisions, the current pace of inventory buildup is putting more downward pressure on overall home prices. It describes how rising inventory outpaces weak demand, saying over the past 12 months, inventory has improved significantly amid rising new listings, rebounding to near pre-pandemic levels and even exceeding them in recent months. It makes an excellent point, though, when it says, when viewed with months' supply, the sharp increase in inventory is also indicative of weak demand struggling to keep up with the growing supply. And really, we do have issues on both sides of the fence here. realestatenews.com reports a rise in inventory is giving home buyers more choices, but economic uncertainty and affordability continue to drag on sales. So from our home buyers' perspective, we have concerns about the economy as well as our ongoing issue with affordability. Then on the seller's side, Real Estate News reports sellers are out of sync with buyers on pricing. It goes on to explain, although recent data suggests the housing market is becoming more balanced or even favoring buyers, home sellers have been slow to adapt, asking for more than buyers are willing to pay. Redfin reports there is a growing disconnect between what sellers think they can get for their homes and the direction the market is actually moving. Now, boots on the ground. I can tell you this is absolutely happening. There are buyers who bought at the top of the market in the early 2020s who think they should have a whole lot more equity than they do. In fact, over the weekend, I ran a market analysis on 2 different homes a client was considering, and both of them came back wildly overpriced. And these we're not talking about new construction homes either. These were individual sellers who compared what they paid 4 to 5 years earlier, and they expected that there had been like rapid price appreciation. One of the homes was priced at $597,900 with a market analysis suggesting a list price in the $568,000 range. And the second was priced at $725,000 with a market analysis suggesting the $650,000 range. The end result of this is we see all of our market dynamics, higher inventory, homes on the market longer, okay, all of that. But here's the thing, it's not hitting every part of the market the same way. In fact, I would say our pre-owned homeowners having to compete with new construction are in the most trouble. A pre-owned home in a landlocked suburb with no new construction is a completely different game compared to one that's surrounded by brand new homes. An individual seller cannot compete with a corporate builder. I want to give you some insight into what we're seeing here. In Denton County, we see homes for sale are up 26% for new construction and 72% for resale homes. Total new listings are up 21.9%. In Collin County, we see homes for sale are up 40.5% for new construction and 74% for resale homes. Total new listings are up 21.9%. In Tarrant County, we see homes for sale are up 3.6% for new construction and 30.4% for resale homes. Total new listings are down 0.4%. Then in Dallas County, we see homes for sale are up 21% for new construction and 45.6% for resale homes, with total new listings up 13.4%. Then sliding over to Rockwall County, we see homes for sale are up 31.8% for new construction and 52.6% for resale homes, with our total new listings up 29.8%. Then in Ellis County, we see homes for sale are up 3.7% for new construction and 21.7% for resale homes, with total new listings up 13.8%. You know, I mentioned earlier about the growing disconnect we're seeing between buyers and sellers in terms of pricing, and you can really see that playing out in the metrics as well. So not a big surprise. Realtor.com took a survey in March where 81% of sellers said they expect to get their asking price or more when they decide to list their home. Many of our sellers bought in the high-pressure pandemic boom of multiple offers. So unless they're plugged into the housing market on a regular basis, they just don't know how much inventory has grown and how much the market has changed. So we have our sellers thinking they're going to get asking price or more, but when we check in on the data, we see that's not the case at all. In Denton County, pre-owned homes are selling for 96.8% of their original list price, while new construction homes are averaging just 93.5%. In Collin County, pre-owned homes are selling for 96.6% of their original list price, while new construction homes are averaging just 93.8%. In Tarrant County, pre-owned homes are selling for 96.4% of their original list price, while new construction homes are averaging just 95.7%. In Dallas County, pre-owned homes are selling for 95.8% of their original list price, while new construction homes are averaging just 96.2%. In Rockwall County, pre-owned homes are selling for 94.9% of their original list price, while new construction homes are averaging just 92.7%. And then in Ellis County, pre-owned homes are selling for 95.5% of their original list price, while new construction homes are averaging just 93.4%. So from where I'm standing, all right, sellers are not getting their asking price or higher. I think what can be misleading is that even now, you see many YouTube videos claiming Dallas is in a seller's market. More and more are acknowledging it's barely a seller's market, but a seller's market nonetheless. There is a long-held metric about months supply that supports this. As Realtor.com puts it, historically, 6 months of supply is associated with moderate price appreciation, and a lower level of months supply tends to push prices up more rapidly. Narada Investments explains, as a general rule, 5 to 6 months of inventory is considered to be a normal or balanced market. Over 6 months of inventory and we have a buyer's market. If it is less than 5 months, we have a seller's market. The problem with this belief is that it simply isn't accurate. The housing market is more complex than that. In fact, I like what Bigger Pockets has to say. All right, they write, it's time we start redefining what a balanced market is. He talks about the month supply metric, and he's like, you know, isn't this a little bit odd compared to what we're actually seeing in the market? And it is. In fact, with the data I've already given you in mind, let's go ahead and add in the month supply. Okay, you ready? The Denton County month supply is 4.5. The Collin County's month supply is 4.4. The Tarrant County month supply is 3.6. The Dallas County month's supply is 4.6. The Rockwall County month supply is 5.8, and the Ellis County month supply is 4.8. You can see if we relied on this metric, we would expect to see characteristics of a seller's market, and that's not what we're seeing. Now, one big contributing issue I see that really interferes with the accuracy of this metric is that only like approximately a third to 1/2 of new construction is actually listed on the MLS. So we have this massive supply of homes for sale and being sold that never make it into the month supply measurement. So if you're hearing that, the whole seller's market thing, all right, if you've been told that, just keep in mind the person sharing it may not have the full picture. Another variable to keep in mind is that just because a seller has wrong expectations about the market doesn't necessarily mean they're going to face reality and come down on price. This isn't just about educating them. It's also about their level of motivation. So, how's this playing out in the market? Well, we're seeing quite a few canceled and expired listings. If this is purely a discretionary move, your seller can choose to wait out the market. So as always, right, negotiations need to be handled skillfully here, making the seller feel like they've won, even if they do have to come like way down on price. So if you fall in love with that overpriced home, okay, you can't just browbeat them into coming down in price, okay? It is gonna take skill. On the other hand, we definitely have motivated sellers out there. I mean, think about how popular the 2-1 buy down is. And if you're not familiar with what that is, Investopedia gives us a great definition. It says a 2-1 buy down is a mortgage agreement that provides a low interest rate for the first year of the loan, a somewhat higher rate for the second year, and then the full rate for the third and later years. Well, think about where we are right now, all right? The 2-1 buy down became so popular when rates skyrocketed midway through 2022. All right, and so then you have like this terrible mantra begin to marry the house and date the rate with, this assumption that rates would come down and you could always refinance. Some of our buyers who bought more than they could comfortably afford back then, thinking they'd just refinance later, they're stuck now. In 2023, they had a nice low rate. In 2024, the rate adjusted to its somewhat higher rate, and in 2025, it is now at its full rate. So we're on year 3 of when the 2-1 buy down first hit the streets. So would you say some of the homes hitting the market right now are coming from sellers in this position? Oh, absolutely they are. So we've talked about where our sellers are with this, right? But why are buyers so reluctant to enter the market? Well, a lot of this comes down to their confidence in the market as well as their ability to enter the market. The Conference Board collects data and provides reports on indexes. They reported that their consumer confidence index fell by 7.9 points in April to 86. The present situation index, based on consumers' assessment of current business and labor market conditions, decreased 0.9 points to 133.5. The expectations index, based on consumers' short-term outlook for income, business, and labor market conditions, dropped 12.5 points to 54.4, the lowest level since October 2011, and well below the threshold of 80 that usually signals a recession ahead. Stephanie Gucard reports consumer confidence declined for a 5th consecutive month in April, falling to levels not seen since the onset of the COVID pandemic. She goes into a lot of detail about it. She said the decline was largely driven by consumers' expectations. The 3 expectation components, business conditions, employment prospects, and future income, all deteriorated sharply, reflecting pervasive pessimism about the future. She continues, notably, the share of consumers expecting fewer jobs in the next 6 months was nearly as high as in April 2009 in the middle of the Great Recession. On to even more good news. High financial market volatility in April pushed consumers' views about the stock market deeper into negative territory, with 48.5% expecting stock prices to decline over the next 12 months. Guicard continues explaining, write-in responses on what topics are affecting views of the economy revealed that tariffs are now on top of consumers' minds. So consumer confidence is definitely a big factor for why buyers are hesitant, why our inventory is piling up, and why days on the market are so much longer. But we also have affordability to contend with. It doesn't matter how much inventory we have if a buyer can't afford to enter the market. I think we tend to throw around the word affordability without really quantifying how much of a problem it is. And I like that the Texas Real Estate Research Center gives us some great data points on this. They have an actual Texas Housing Affordability Index to measure how affordable an area is, with an increase in the THAI indicating a family is better able to afford the median priced home. The chart shows that in 2012, the THAI was 2.38. In 2020, it was at 1.71. In 2022, it bottomed out at 0.96, and its most recent measurement has shown affordability has actually improved a little bit to a 1.13. So Dallas continues its struggle with affordable housing, but it has improved slightly. Believe it or not, rate volatility also really affects affordability and a buyer's ability to enter the market. Let's just say a buyer can afford a $350,000 house at 6.6% interest, which is what the rate was on April 4th. Well, by April 11th, the rate had increased to 7.07. Now our buyer only qualifies for a $330,000 house. Literally within 1 week, they lost $20,000 in buying power. And this is what rate volatility can do. Like, you fall in love with a $350,000 house, and then a week later you can't afford it. The Mortgage Rate Volatility Index does a great job of communicating this. Rate volatility is off the charts, and it's handicapping buyers and keeping our unabsorbed inventory rising. Bank Report describes how President Donald Trump's tariff policies spurred a spasm of market swings. It continues, the housing market is facing a repeated challenge from a recent jump in mortgage rates, which are likely to remain volatile and elevated, particularly considering the Federal Reserve's independence being called into question. So in a time when supply is steadily climbing, we have a lot of reasons for why buyers aren't buying. Now, we've talked a lot about our individual buyers and sellers, but I do want to focus on new construction for a minute. We've already looked at rising inventory, but one thing we haven't touched on yet is contract ratios. That metric gives us a real sense of how in demand an area actually is. It's a key piece of the puzzle when it comes to new construction, showing us which areas are heating up and which ones are stalling, so you can spot where the real opportunities are. As we're going through this, keep in mind a 36.5 would be roughly like a balanced or warm market. A higher number would mean a hotter market, with a number below 36 meaning a colder market. So what I want to do is I want to take some of our biggest new construction hotspots and see how their excessive inventory is affecting them. So let's start out in Denton County, okay? So in Denton County, let's talk about Aubrey, all right? In Aubrey, you have active listings, 82, with 34 under contract. That gives us a ratio of 41. Now in Denton, active listings are 138. Under contract, you have 56, which gives us a ratio of a 40. In Justin, we have 129 active listings, 42 under contract, which gives us a ratio of 32. Now let's move on to Collin County, and absolutely we have to talk about Salina. In Salina, we have 349 active listings, 96 under contract, which gives us a ratio of 27. Moving on to Prosper, we have 106 active listings, 17 under contract, which gives us a ratio of 16. Moving on to Princeton, we have 312 active listings. Under contract, we have 182, giving us a ratio of 58. In McKinney, we have 319 active listings, 114 under contract, which gives us a ratio of 36. Now, let's move on to Rockwall County. In Rockwall County, let's talk about Rockwall. We have 121 active listings, 29 under contract, which gives us a ratio of 24. Then we have Royce City. We have in Royce City 179 active listings, 63 under contract, which gives us a ratio of 35. I hope you're seeing here that we've got some exposed builders with a lot of inventory that's moving very slowly. I do want to give you a word of caution though. If you approach it with that mindset, You may believe them if they tell you the builder is motivated and they've just, really cut their prices. So listen to me when I tell you, if you take that at face value, you've already lost. All right, you need to understand the price cutting strategies they use. I explain all about that in this video that you might want to watch next. In the meantime, this is Wendy Pinnell, and I'll see you in the next video.